It seemed like regulators wanted to blame crypto instead of the significant rise in interest rates and the deposit outflows. Now we're seeing it as a solution to the problem, but the regulators are still reticent.
According to Cathie Wood, the CEO of ARK Invest, cryptocurrencies have become a safe haven during the current banking crisis in the United States. Amid concerns of contagion following the collapse of Silicon Valley Bank, investors are turning away from banking stocks and towards Bitcoin, which has emerged as an unexpected beneficiary. Wood shared her thoughts on Bitcoin's recent price surge in a Bloomberg interview, stating its price behavior through the crisis is going to attract more institutions. As for the impact on Bitcoin's price from the institutional interest, Wood explained in the interview that ARK Invest $1 to $1.5 million Bitcoin price prediction by 2030 was made on the back of an institutional investor Bitcoin allocation analysis, which estimates most firms would allocate between 2.5% to 6.5% to Bitcoin in their investment portfolios. Cathie Wood stated that recently, when we felt Coinbase was so misunderstood, and when it seemed like the banking regulators were blaming crypto for what's going on right now, which is not the case at all, we actually thought, nope, we think crypto assets could be a beneficiary, a flight to safety. Recently, Wood tweeted that why have Bitcoin and other crypto assets appreciated during this banking crisis? In our view, and in contrast to those in the traditional financial world, many crypto assets face no central points of failure. They are decentralized, transparent, and auditable. Before proceeding further in this video, make sure to click on the subscribe button below to stay updated with our latest content.
Innovation solves problems, and you showed a few charts at the beginning that suggest that some of the innovators out there are solving problems. I mean, I think the most dramatic example of it to us was the behavior of Bitcoin last week. It absolutely took off. It was a flight to safety vehicle. And so it is really proof of concept that innovation solves problems. There are, in Bitcoin, fully decentralized, fully transparent, auditable, which is addressing all of the banking's problems right now. And so a flight to safety, a little bit of an insurance policy. There's no central point of failure in Bitcoin. Crisis is liquidity dries up, so that tends to hurt assets. And the fact that Bitcoin moved in a very different way from the equity markets in particular was quite instructive. You'll find the building blocks of those price targets in our Big Ideas 2023. So ARK Big Ideas 2023, and they are, for the base case, I would suggest quite conservative. We've dialed some of them down since last year. I know that corporate treasuries pulled away from Bitcoin because the regulators were pulling them away from Bitcoin on their balance sheet. So we've pulled back there. But we do believe that the behavior of the price through this crisis is going to attract more institutions, for example. We've done a report targeting institutional investors and the allocation that they should make if they care about this new asset class diversifying their portfolios. And I believe it's somewhere between 2.5% and 6.5%. So not crazy. These are the sorts of allocations they would have made to emerging new categories of assets like real estate in the 70s, emerging markets and small cap in the 80s and 90s.
Famed money manager Cathie Wood bemoaned the Federal Reserve's aggressive interest rate hikes over the past year, saying they hit ARK Invest's strategy like an earthquake. Wood criticized the Fed for being unable to avert bank runs despite all the signs being there. Cathie said she was baffled that banks and regulators could not convince the Fed that disaster loomed. Cathie Wood pointed out that the ongoing banking crisis can be primarily attributed to the Federal Reserve's policies, which have caused a drought in venture capital funding. The Fed has raised benchmark rates by 450 basis points since March 2022 in an effort to tackle record-high inflation in the U.S., which has resulted in regional banks transitioning from a liquidity crisis to a solvency crisis. Wood tweeted that the asset or liability duration mismatch, securities earning only 1 to 2% versus deposits paying 3 to 5%, became untenable as deposits started leaving the system. Like SVB, some banks were forced to sell HTM securities, recognizing losses that depleted their equity accounts. Wood said in a series of tweets, crypto did not force SVB and Signature into bankruptcy. In my view, Fed policy was the primary culprit.
Liquidity issue, but not really the solvency issue from our point of view. A couple of things have happened here that have never happened really in history, and so the banks didn't expect it. The first was interest rates up 19-fold in less than a year. Never happened. Under Volcker, which it was twofold, 10 to 20%. And the low base does matter. Many people dismissed it, saying, oh, just such a low base. No, expectations were low base. So that was the first. We've never seen that magnitude of an earthquake, I would say. Then the second thing that no one expected, again, because it hasn't happened in such a long time, was deposits leaving the system. For Silicon Valley Bank, it was venture capital facing a funding drought, and so they had to draw down their deposits. But then for others, you've got money market funds paying much higher than deposits, attracting flows. So that combination was lethal. And so now they have the backstop in. Now what do we have? We have they're going to be paying up if they're depending on the facility. They'll pay roughly 4.37% right now is that rate, OIS plus 10. And that's much higher than many of them have been paying for deposits, number one, while in the case of Silicon Valley Bank, their average held to maturity security on the asset side of their balance sheet was only 1.6. So they're going to see net interest losses. Now, instead of having mark-to-market hit equity, these losses are going to hit earnings.
The 20-fold increase in the Fed funds rate will make regional banks and the equity and bond holders to be wiped out. If commodity prices experience a downward trend, it could imply weakened demand from consumers or slower economic growth, which may raise concerns for investors. Moreover, falling commodity prices may signify deflation, a continuous decline in the overall price level of goods and services. The bond market has also suffered due to the Federal Reserve's year of rate hikes. The yields on two-year U.S. Treasury notes have surged over 200 basis points, reaching 4.23% within the last 12 months, whereas 10-year yields have risen 130 basis points, reaching 3.63% over the same period. When prices fall, bond yields rise.
That last year was the most unusual year of my investment career. And not only mine, but bond investors. So bond investors had the worst year in 200 and some odd years. When interest rates go up 19-fold in less than a year, it's going to kill long-duration assets. Bonds are long-duration assets. They've never seen a year like that. ARK is a long-duration asset. But if we're right, and these companies are going to disrupt the traditional world order, then we want to be on the right side of change, and the market will come our way, away from those benchmarks, which represent the traditional world order, to our strategies. No, if you look at upstream, what's going on, commodity prices coming down quite dramatically, some by 70, 80%. And I would also say the retail call was very right. I think you'll agree on that. The discounting, we think, is going to continue to work its way through the system from the commodity price level to downstream near the consumer. And you can see this. Tesla is cutting prices. Many people say, oh, it's because of competition. No, it's because their commodity prices are coming down. And Elon's even talking about deflation. And the cost associated with innovation is coming down because it follows a learning curve. So I think the innovation that our companies are delivering are going to be one part of the deflation. Commodity prices and another. And I will also tell you, the yield curve, the week before last was down, inverted by as much more than 100 basis points. That also is a deflationary signal, as is what's now going on in the banking system. I think the banking system is fearing deflation.
The collapse of the Silicon Valley Bank has rocked the markets, raising concerns that other banks could be facing similar problems. By taking a look into Cathie's tweet, we can clearly analyze her views as she considers crypto to be a solution of ongoing financial crisis. In our view, crypto is a solution to the central points of failure, the opacity, and the regulatory mistakes in the traditional financial system. Made the scapegoat for policy mistakes, crypto will move offshore, depriving the U.S. of one of the most important innovations in history. On this note, we conclude today's video. Do you agree with Cathie Wood's perspective on the given issue? Share your thoughts in the comments section below. If you found this information helpful, then like this video and subscribe to our channel. We will continue to bring you more updates in the future.